Hi everyone, I'm Joanna James Abad-Rayutina. So my report is taken from Chapter 10, Banking and the Management of Financial Institutions. So I will only discuss two important topics, which are balance sheet and its two important elements, which are liabilities and assets. So I will also include what are those accounts that can be considered by the bank as liabilities or as assets. So the bank's balance sheet is a list of the sources of bank's funds or liabilities and the uses to which funds are put or assets. So the correct equation of the balance sheet is that the total asset must be equal to the sum of the total liabilities plus capital. So a bank acquires funds by issuing or selling liabilities such as deposits. So these deposits are considered as source of funds by the bank. So the funds obtained by selling securities or by issuing securities can be used to purchase income earning assets or investment such as buying buildings. So that building can be used for manufacturing a product or for rent. Checking deposits are bank accounts that allow the owner of the account to write checks to third parties. So checking deposits include all accounts on which checks can be drawn. So these are demand deposits. So demand deposits are non-interest bearing checking accounts. Second one is the negotiable order of withdrawal. These are interest bearing. And the last one is the money market demand accounts. So according to Depository Institution Act of 1982, MMDAs or money market demand deposits are similar to money market mutual funds and included as checking deposits. However, MMDAs are not subject to reserve requirements and they are not included in M1 definition of money. In 1960, checking deposits were considered as the most important bank funds, but the appearance of more attractive financial institutions such as money market deposit accounts, the checking deposits in total liabilities has shrunk over time. So these checking deposits and MMDAs are considered as payable on demand. That is, if the depositor shows up to the bank and requests for payment by making withdrawal, the bank must pay the depositor immediately. So we can say that checking deposits are asset to the depositor and a liabilities that the bank must pay. They are considered as the lowest source of bank funds because the depositor is willing to pay interest to have access to the liquid assets until that they can use to make purchase. So the bank's cost of maintaining checkable deposits are interest payment and costs incurred in servicing these accounts. So these include for processing and for preparing. Non-transaction deposit is the primary source of bank funds. It consists of 55% of bank liabilities. Owners cannot write checks in non-transaction deposits, but interest paid is usually higher than the checkable deposits. So there are two types of non-transaction deposits, which are savings account and time deposit or certificate of deposits. Savings deposits are the most common type of non-transaction deposits. So in this account, funds can be added or can be withdrawn at any time. So the transaction and the interest payment are recorded in a monthly statement or in a passbook held by the owner of the account, while the time deposits have fixed maturity date ranging from several months to over 5 years and have substantial payments for early withdrawal. Small denomination time deposits are deposits less than $100,000. So it is less liquid for depositors than passbook savings. It earns higher interest rate and more costly source of funds by the bank. Large denomination time deposits are deposits which are $100,000 or more. So these can be sold to corporation or other banks. So these are highly negotiable and can be sold to secondary markets before they mature. The banks also obtain funds by borrowing at the Federal Reserve System, the Federal Home Loan Banks, other banks, and corporation. So these borrowings from the Fed are called discount loans. So the bank borrows fund overnight to have enough deposit at the Federal Reserve and to meet the amount required by the Fed. Other sources of borrowed funds are loan made by banks to their parent companies, loan arrangement with corporation, and borrowings of Eurodollars. So borrowings are more important source of bank funds over time. Currently, they are 22% of bank liabilities. Bank's capital is the final category on liability side of balance sheet. So, it is the bank's net worth which equals to the difference between the total assets and liabilities. It is raised by issuing new equities or retained earnings. The bank's capital is a caution against a drop of its value on its assets, which could force the bank into insolvency. Bank assets are those naturally referred to as uses of funds and interest payment earned on them, which enables the bank to make profit. All banks hold some of the funds they acquire as deposits in an account at the Fed. Reserves are these deposits plus currency that are physically held by bank or called vault cash. Reserves earn low interest rate, but banks hold them for two reasons. The first reason is some reserves called required reserves is held because of its reserve requirements, a regulation that for every dollar of a checkable deposit in a bank, a certain fraction must be kept as reserve. This fraction is called required reserve ratio. And the second reason is bank hold additional reserve or excess reserve because it is known as the most liquid of all bank assets, and bank can use them to meet its obligation when funds are withdrawn either directly by a depositor or indirectly when checks are written in an account. Another bank asset is cash items in process of collection. So the check is classified as cash items in process of collection, and it is also classified as asset for your bank because it is a claim on another bank for funds that will be paid within a few days. Another bank asset is deposits at other bank. So small banks hold deposits at larger bank in exchange of variety of services, including check collection, foreign exchange transaction, and help with securities purchases. This is an aspect of a system called correspondent banking. So, reserves, cash items in process of collection, and deposit at other bank are also referred to as cash items. Next one is securities. So, a bank's holding of securities are most important income earning assets. It is made up entirely of debt instrument for commercial banks because banks are not allowed to hold stocks. It provides commercial banks with about 10% of their revenue. So there are three categories of securities: U.S. government and agency securities, state and local government securities, and other securities. So the U.S. government and agency securities are the most liquid. Because of this, short-term U.S. government securities are also called secondary reserves. A bank makes profits primarily by issuing loan. So, a loan is a liability for individual or corporation receiving it, and an asset for the bank because they receive interest payment. So, typically, they are less liquid than other assets because they cannot turn into cash until the loan matures. The final category is other asset. So, the physical capital owned by bank are included in this category. Example of these are bank building, computers, and other equipment.